India's financial services sector is poised to grow on the back of rising incomes and the increasing pace of digital adoption. As the sector continuously reinvents itself, newer products, more categories of market participants, and faster processes aided by technology will pose phenomenal challenges. Can regulations and regulators anticipate the future? Our panelists for this session, Mr. Ashish Kumar Chauhan, the Managing Director and CEO of the National Stock Exchange and one of its founders, where he worked from 1992 to 2000. Prior to becoming the MD and CEO of NSE in 2022, he led the Bombay Stock Exchange, the first stock exchange of India, as its Managing Director and CEO. He's presently the Administrator and Chancellor of the University of Allahabad. And Mr. Chauhan is best known as the father of modern financial derivatives in India. He was instrumental in setting up India's first fully automated screen-based trading system and the first commercial satellite communications network. He also created several path-breaking frameworks, including the Nifty Index, NSE certifications in the financial markets, etc. The National Securities Clearing Corporation and NSDL were all conceptualized by him. Mr. Amitabh Chaudhry is the Managing Director and CEO of Axis Bank. Under his leadership, the bank is undergoing a well-outlined multi-year transformation program, which is expected to catapult the bank to becoming an even bigger premier financial institution of the country. Before joining the Axis Bank, Mr. Chaudhry had a long and successful stint at HDFC Life. He's held senior positions in a number of foreign and Indian institutions, and he's also the chair of the FICCI Committee on Banking and has served as director on the boards of several reputed companies. Mr. Gurumurthy Mahalingam, former whole-time member of SEBI, is a director on the boards of some large and significant entities. He's had a professional career of over 4 decades, spanning across the financial sector regulators, the Reserve Bank of India, and SEBI. At RBI, he has taken on various roles encompassing financial market development, regulation and operations, foreign exchange reserves management, debt management, and regulation and supervision of banks. In his role as a whole-time board member of SEBI, he had wide experience regulating mutual funds, stock exchanges, listed companies, foreign portfolio investors, corporate governance aspects, stock and derivatives markets, corporate bond markets, among others. He's also agreed to be the moderator for this session. So as we didn't have a Q&A session for the first inaugural session, we will be having Q&A sessions for all our other sessions. So just a house rule, if you can please raise your hand, the microphone will be sent to you, and we will of course allow our moderator to decide the order in which the questions are going to be asked, and of course he is boss as far as the stage is concerned, so please continue to listen to his instructions and follow his directives. There is a timer on the floor, so we'd like to keep the questions as short as possible so that we can accommodate as many as we can. Mr. Mahalingam, it's over to you now for the session.
Yeah, thank you very much. First of all, let me profoundly thank Mr. Damodaran for giving all of us this opportunity to participate in this governance conference. This is probably the 3rd or the 4th governance conference of Mr. Damodaran's Gatekeepers of Corporate Governance that I am participating. As an earlier speaker mentioned, I consider this has become a kind of a brand as far as a corporate governance conference in the country is concerned. So it's a privilege for all of us to be here, to be participating and hearing out each other and sharing the experiences and comparing the notes. This is going to be a slightly different kind of a session, whereas Mr. Damodaran himself mentioned, we are going to take a peek into the future as far as the financial regulation is concerned. Perhaps, maybe we lace it with some of the governance aspects also, but then the main track is going to be on the financial regulation, how it is going to pan out in future, and we will lace it with how the regulators should be actually having a set of binding set of governance norms as the market evolves, as the regulation evolves. All of us are aware that in the aftermath of the global financial crisis, the whole world of financial regulation has undergone a huge change. We have a number of regulations which have been flooding the country from the Western jurisdictions, all in the form of trying to prevent a crisis. We have a liquidity coverage ratio, we have a net stable funding ratio, we have capital buffers which have been now put on the banking industry. So all these are not probably new to India at all. We have already been practicing these kinds of liquidity ratios in the form of SLR, which are simple, may not be as complex as what we are practicing now. Nevertheless, the compliance burden, the compliance costs have gone up over a period of time. I am very happy that I have one veteran banker and a veteran capital market person with me to answer the questions. So my job is to pose all the difficult questions to them, get the answers. I don't need to thankfully answer. I'm just going to lace it with some of the views and experiences that I gathered as a regulator. Clearly, starting with the global financial crisis, as what I mentioned, the central bankers have now, banking system itself is now on the track of financial stability as a prime objective. But when you look at it, the central bankers themselves across the world are triggering this financial stability crisis by injecting a huge amount of liquidity. There is an inherent conflict out there. Similarly, between the Western jurisdictions and the emerging market economies, while the emerging market economies are trying to get more and more of inclusive growth into the system, the Western economies are trying to tighten the system and increase the compliance costs and increase the compliance burden. Perforce, we have to fall in line. So I would like to know, first from Amitabh, as to how does he look at the regulation evolving in the midst of this kind of a conflict, where actually India is pretty well positioned in terms of economics, in terms of politics, but yet it has to actually chart out a very, very careful path. So how do you think the Indian regulation is going to evolve? How is the global regulation going to evolve? Maybe in the next about few years. How is India going to really look at that? Amitabh.
Firstly, thank you, Mr. Mahalingam, and thank you, Mr. Damodaran, for inviting me to this chat. Seriously appreciate it. The good news about the question which you asked is this does not apply just to central banks. It applies to central governments also. Exactly the same situation, exactly the same conflict and same contradiction. On one side, you want to push the country's agenda. On the other side, the globe expects you to behave in a particular way. And I think India went through that, or a bit of it, when we started buying oil from Russia and what the reaction was. And I do believe India handled very well. So yes, you're absolutely right. Firstly, with the global flows and the global interconnects which are happening, the global regulators expect that they will be talking to each other. There are enough guidelines which are being developed globally, where people have come with guidelines on globally important banks, globally important insurance companies. India has a similar concept, and the other thing is that the regulators are also meeting each other very regularly and discussing how will they manage this crisis as they go forward. The second principle we should be aware of is that the regulators tend to act, or a lot of regulations tend to come when there is a crisis. You talked about this particular crisis, the way crypto is blown up, another crisis. Tomorrow cybersecurity happens, another crisis. A disorganized way a bank might blow up, another crisis, and you will see a slew of regulations come in. I think the way the world is evolving and the way central banks are evolving, I think it is very clear that they will first look at what they need to do themselves, and then they will try to see whether globally they can accommodate some of the requirements which are being placed on them. I think that's how the geopolitical order is emerging, and I do not see any reason why it will be something different on the regulatory side also. We have to look at what India needs and what is right for India, and then obviously take into account what the global regulators want and try to accommodate that. I mean, there are enough global organizations like FIUs and obviously there are a lot of foreign banks present here. A lot of us use, dollar clearing, euro clearing, and we cannot ignore some of those aspects. And I think the regulators will try to accommodate that as we move forward. But at the same time, they want to see what is required for India. So, for example, the war has taught us and taught all the regulators around the world that they need to have the independent local payment systems. Because tomorrow, if you're going to rely on global payment systems and something happens, you could be shut off and you could actually have a problem in terms of making payments across the world. So China is talking about it, India is talking about it, and the same thing is circulating around other parts of the world also. So I think some of this interconnection is forcing people to come together, but some of the actions and some of the pressure which is being applied to come together is also forcing regulators to look at how they can create independent, self-sufficient, isolated systems so that they can exist on a standalone basis if it comes to that. So you're seeing kind of both things happen. So it's a balancing act, but my view is country will come first, global requirements will come second, and all of us know what they want, so keeping that taking that into account. My second view is that some of these crises which you're talking about will lead to more and more regulations. And we have had a couple of things blow up recently. Crypto is a good example. Already there is a demand all over the world that we need to control it. RBI, if you look at it, has had a very firm entire view of crypto. And obviously there are, I'm sure, patting themselves on the back in terms of being tough about it. You will see the same thing on the fintech side, where slew of regulations have started coming, more will come. And I'm now seeing increasing concern because even the companies which are providing the software and the platforms and the cloud solutions to the banking system or to the financial system at large, the number of companies who are doing that is whittling down to 3 or 4 at best. In many cases, for example, Indian banking system relies on software of only 2-3 companies. So there's an emerging risk that tomorrow if some of those companies stop investing in the software and in ensuring that those platforms are adaptable to this new world, the investment is not enough. It is creating a huge risk in the financial system because then you're more vulnerable to cyber issues, you're more vulnerable to not being able to scale, you're now more vulnerable to the fact that you're not able to adopt to some of the new technologies which are coming in. And I see that as an emerging risk, which in many cases some of these vendors and some of these software providers are global players. So that again, it forces another contradiction. While you want to engage with them, at the same time you're worried, what will happen if somehow some of them refuse to engage with you or refuse to invest? Where do you go? So I think these are some of the emerging risks. I think when I talk to the regulators, they seem to be very aware of it. And to give you another example, when IPL happens, the UPI requirements shoot up because people are maybe using some sites to go and bet or do whatever they want to do. Now the pressure is coming on the banking system to continue to invest in technology to take care of IPL requirements. And we have to bear all the cost. So again, it comes down to someone is doing something out there and we have to invest a lot of money to ensure that we are scalable, sustainability is there and the resilience is there. So the interconnection is causing problems within India also. I was just trying to highlight that. So I would say right balance, but India will come first.
Thanks, Amitabh. I think this question I'll tweak a little bit for Ashish. Ashish, actually, again, large volumes of capital flows enter the country and they first go and actually affect the capital markets. A huge amount of volatility results in the capital market and this itself becomes a kind of a trigger for the financial instability. Now, do you think in this kind of a milieu, this is again an old question, but I thought that let me have your views on that because this question keeps getting examined again and again across the jurisdictions. We have 2 different regulators actually handling the capital markets as well as the other markets. Now, at some point of time in the past, we thought about whether there should be a unified regulator to look at it and have a coordinated approach towards managing both the capital markets as well as this. What will be your views as we go forward? Is this kind of an idea going to gain greater strength or is it going to actually, the present status quo is going to continue? How do you think it's going to evolve?
I think there is a longer answer to this. But as we we stay in a particular situation, it becomes suboptimal, or it looks suboptimal whenever we are in that situation. So we are in currently a sectoral regulator situation, and because we actually observe it, we experience it every day, we think that is bad, and something else which other people are doing might be good. It is actually a natural thing. Whatever we are in is bad, and we want to get out of it, so we think the other side is good. So how did these regulators come about, right? Earlier, the regulations, largely there was RBI in India, and then CCI and all part of the government. Then on the basis of the US model, we created regulators, SEBI and other sectoral regulators, and that's what became now what I call a legacy system. 30 years, we have kind of spawned many regulators, but effectively it's a legacy system now, and we think that is kind of hindering what we want to do. So somewhere else, something nice must have happened, and this is hell, and that must be heaven, because wherever we go away from here, that must become better. And somewhere there are experiments, and we also, of course, thought about it as a country. A committee was set up called FSLRC, Financial Sector Legislative Reforms Council, several years back, I think 2012 or something, or in that range. And a lot of us brainstormed over 1 or 2 years. We came out with a framework about it should be, instead of sectoral, it should be basically about sort of separately facing the customer, separately microprudential norms, macroprudential norms, and so on and so forth. And that FSLRC report is still there. But while looking at it, we realized that there are other countries which have actually implemented, and that is UK. UK has actually implemented similar stuff which FSLRC broadly came about. And I'm not trying to justify UK style or what is our style. There may be what I call gradual ways. If something is suboptimal, we can of course take away that portion from a regulator and pass it on to somewhere else, rather than trying to make a wholesale kind of change, because once that system comes up, it'll be equally bad. It's just that today we are feeling constrained, so we want to get out of this, and we will end up going from sort of frying pan to fire, and that's how I see it. So no system is going to be perfect, because situation changes so fast, and systems, people want that to maintain status quo. Why systems evolve? For me, I mean, I have a philosophy of law and order. That order comes first. The entire society wants order, and law is actually codified order. So whatever's good, bad, ugly, everyone wants to stay within, because all of us are in a way uncomfortable, but largely we are comfortable. And so any change in a way is going to be resisted. But once the new system comes, like after French Revolution, a new system came, and those people are now revolting again, right? And so that's where basically we need to be aware that no system is going to be perfect. People want stability. Change is inevitable, and in newer world, because the technology is the only change that happens. And technology waves used to come slower earlier. They are becoming faster. So many of our systems, our processes, our institutions are going to look very, very outdated very soon in each area. And we need to continue to update ourselves, more coordination across regulators to just keep pace with that. And that's how I would put it. Whichever system you kind of set up is going to become obsolete, outdated very soon if you don't keep the pace. Yeah, how do you keep pace with the changes? The people are kind of more important to whoever we put in as regulators and also coordinators. Will have to be aware of the technologies that are coming. They'll have to take bets. For example, say blockchain, right? Today morning I sent him a message which said that ASX, Australian Stock Exchange, after 7 years of tom-tomming about setting up a blockchain-based clearing system, has actually abandoned yesterday officially. But they were not abandoning for last 5 years. 5 years back they had figured out it's not working. Under the crypto ecosystem, pressure, they were ensuring that they cannot say that this is not working. And that is how the regulators will also have to be savvy. They'll have to take bets and so on and so forth. Effectively, it is about how good our society is about figuring out what is going to work, what is not going to work, and so on and so forth, rather than kind of wholesale changes, because wholesale changes will create even more risks than what we think.
Thank you, Ashish. I'm going to stick to you on the technology aspect. I think technology has become the fundamental edifice in the capital markets today. I think without technology, nothing can move in the capital markets at all. But the technology will have to be absolutely be secure. It will have to ensure continuous operations. It will have to be completely resilient. So all these are fundamental prerequisites of good technology. And to be very frank, I think the regulators have kept their hands off a little as far as the technology is concerned. I mean, they have been able to manage the liquidity risk, the market risk, the credit risk, but the technology risk, the regulators have been keeping their hands off. Now, how do you think this is going to pan out in future? Do you think the regulator will have to actually have a hands-on approach as far as technology is concerned? Or is it going to be something which the market institutions themselves have to decide over a period of time that this is going to be good for us? Now, that itself has its downside, that if people adopt different kinds of technologies and we think of interlinkages between the market entities, that becomes a problem. So how do we resolve this dilemma, and how are the regulators going to really ponder over this technology issue on which they are still to really soil their hands?
Now again, philosophically, we can always say it has to be perfect, you know. So technology, even after so many years, Microsoft has basically viruses, right? And they still have kind of a $1 trillion market cap, right? So effectively, to expect a person who is not a Bill Gates to run and in a perfect way, I think is in a way asking for impossible. But that risk exists, whether in a small or large way. How do you mitigate as a society? One is to keep on browbeating that entity or that organization, saying, no, you have to be perfect. If you don't, we'll do this. Or basically spread your risk. What regulators have done, even portfolio managers do, is spread the risk, right? How do we spread the risk? By creating more institutions which are interlinkaged and which are not too big to fail. So for example, we today have a UPI, right? It's a great success story, but it's also too big to fail now. If anything happens there, and if somebody tells me that it is never going to happen, unless proved otherwise, they are right, right? And I will go with them as a disciplined soldier. But otherwise, you know in your heart that if you have 3 such things going on, you are reducing the risk on the system. And that's how I would say that there is a finite risk. There is no risk elimination in technology game, and additional risk keeps on coming because the technology changes so often that basically the risks actually come due to the changes which are regulatory changes. On top of that, the technology itself is adding its own risks, and then the past technology has those vulnerabilities which were not found earlier start getting founded, so it becomes obsolete, it becomes difficult to change. And that's why if you try to now in a way legislate, that's what we did in cryptography, not cryptocurrency, but in basically e-signature and all, we actually specified a technology. For me, once you specify technology, you actually bind your hands to a technology now which is 20-year-old. And that is where basically that understanding in the minds of regulators of where to sort of draw that Lakshman Rekha and how to still create less risky situation for the system as a whole by allowing more institutions which are interconnected. In stock market, for example, as opposed to UPI, we have such a beautiful system. We have 2 exchanges, 2 clearing houses, 2 depositories, right? Risk is actually reduced not by half, it is reduced by now 95%, 98% on the same framework, right? And that's how by quirk of fate it has happened. It's not happened by design. But what I'm saying is, we need to understand intuitively as a society that, like in finance, you cannot eliminate risk completely. In technology, you cannot eliminate risk completely, and we'll have to basically have a portfolio-based approach as regulators to manage the risk coming out of any institutions going forward.
Thanks, Ashish. Staying on technology, Amitabh, one is the banking industry is having a lot of fintechs which are cropping up. Now, these fintechs do provide some backward and forward linkages. They are small firms. They are adding a lot of value to the banking industry. At the same time, somebody may say that they are eating into the business of the banking industry also. So, two questions I have. One is, do you think they are really adding value to the banking industry, or they are actually impediments as far as the banking industry is concerned? Number one. From a regulatory perspective, I think the regulators still have a lot of dilemma how to actually bring them under the regulatory ambit. Now, do you think, first of all, these people have to be brought within the regulatory ambit? They are, after all, sitting at the fringes and they are doing only the fringes job. Should they be brought under the regulatory ambit? Does it stifle innovation? At the same time, if you look at the other perspective there, the guys who are doing these kinds of jobs, they could create a systemic risk also. So should they not be within the ambit of the regulation? Do they enjoy sitting outside the regulatory world, reaping the fruits of non-regulation there? So how do we resolve this dilemma? How are the regulators going to view at it? So both these questions, I would like to have your viewpoints.
So before I just get to the question, let me just make a very broad brush statement that from a technology perspective, I expect the regulators to increase manifold their supervision, oversight, drive, push to ensure that the financial services system, from a technology perspective, capacitization, storage, hollowing the core, all what you need to do from a cybersecurity perspective, they will push that in a very, very big way. And by the way, I can see some of the regulators doing it and making us sign up on timelines in terms of what you need to deliver over a period of time. So if anyone is in the financial services system, they should get mentally prepared that they have to increase the technology spend number of times before the regulator is going to get satisfied. Coming to the specific question on fintechs, I think the regulators have already started kind of defining how they're going to do it. They are saying that if you are a fintech, you have only a couple of models available to you to exist as far as we are concerned. Either you come through the front door and take a proper license so that I can supervise you. If you are not willing to do that, you will be at the fringe only. You cannot come inside that room where I allow you to do many more things. So that is the first principle they have adopted. Second, they are telling the people who are inside the room that if you want to deal with the people on the fringes, I will hold you responsible for ensuring that all the requirements from a risk perspective, customer conduct perspective, ensuring that the customers are protected, the onus is on you. I will hold you responsible. So you convert the people at the fringes as a distributor of yours, so you behave as the main institution who the customer is dealing with, or you ensure that you sign suitable partnerships that they take part of the liability. It doesn't matter. I will hold the entities which are inside the room and supervised by me as the people responsible for delivering on that particular promise. I think fintechs are there to exist. They do a couple of things very, very well. They firstly push the people in the room to get more innovative and do more for the customer than what they would in the normal course be willing to do. So you need that push and pressure. I know I'm kind of beating ourselves up in the process, but I think it is required. Someone coming and questioning the status quo, someone coming and saying this can be done better, customer proposition can be better, customer journey can be better, is good for the overall system. So they are required. They're coming out with innovation also. What is the innovation they're coming out with? Firstly, they're looking at wherever the banks make money, and they say banks or financial services companies make money, and say, I will go after where you make the maximum money, and I will attack that portion of the market, because maybe I can attract customers better, maybe I can give a pricing concession, maybe I can make the customer experience better. I will go and attack that. So that also pushes us to look at what can we do more for the customer. So fintechs are there to stay, to firstly push innovation. Secondly, the innovation is invariably directed towards the profitable pools, the more profitable pools. Rather, no one is going and coming where, no one is going and attacking the PSL side of the market or the priority sector market. No money to be made. No one is trying to come there and say, oh, by the way, I will solve this problem. Because ultimately, they're also getting capital based on this, promise they're giving that I will change the world. Third, fintechs are coming up with new technologies and solutions which could be potentially useful to the system. They are also attracting a certain set of talent which wants to work in that environment. So I think in a nutshell, all of us have to accept the fact that it is a reality. It is good for the overall system, obviously as long as it is controlled. Invariably, innovation will get ahead of regulation. Regulators cannot control it in advance because they don't know what the innovation would be. So regulation will follow innovation. I think the regulators have to be on top of what is happening and introduce regulation as quickly as possible so that things don't happen sometimes which happen. Frauds or customers taken for a ride or customers not taken care of or whatever that might be. But invariably because of, and we've seen this around the world with crypto, what has happened and some of the, people talk about the BNPL and what has happened. Australia, since you mentioned, had 8 or 9 BNPL firms, almost all of them have blown up. So customers have lost. But in that process, the people who have lost money are the ones who are willing to take the risk, knowing fully well that they should not be taking the risk. And hopefully the regulation that follows ensures that both innovation and regulation and customer requirements can be balanced. And I think the regulators in India generally have been at the top of the situation. You will have cases where some customers will lose money. But I think the regulators are now trying to do a lot to educate the customers, don't do this, don't do this. But if someone wants to invest in crypto in spite of what RBI has, for example, been saying in the last 3 years, what can you do? It is what it is. But my view is fintechs are great for the overall financial services.
Thanks, Amitabh.
So just let me add to this. See, basically, if the fintech survive, then they will become tomorrow's institutions. For example, NSE was fintech in 1994, right, when it came. And in those days, I used to call it cyberspace. There was no fintech. It is after 30 years, we call it fintech. But it was in a way, first surviving fintech. But before that, there was not so surviving fintech. It's still surviving. Like in India, we don't allow anything to go down fully. That is OTC, right? In the same market, we had one more fintech which came. It was a collective fintech. I wouldn't say it was individual fintech, but OTC Exchange of India was a fintech. It didn't survive, or it still survives, but not so successful. And similarly, after NSE became successful, in banking, there was another fintech which is now known as HDFC Bank, right? And so, effectively, for me, what survives is part of institutions. What goes down is bad, right? In either business model or otherwise. And that's what we'll have to create that window for newer things to come. Otherwise, we'll again become fossilized, right? And because the evolution is so fast that we'll have to create those windows. But if you have windows where basically it becomes larger than the normal system and too many frauds happen because people also want protection, especially for money and also that is true with equities market or capital markets and also for banking. But there are many functions which today, if you look at any bank, it provides like 500 functions, which is a depository institution, where you can lend to the institution. It's transaction processing platform for international, for local. Many of them are given as a clubbed activity, right? If some of them are doable in a part with lower cost by a new framework, why wouldn't you allow it for the society? Although it may hurt the existing institutions from their toll gate activities and so on and so forth. So those are the philosophical questions. But overall, the technology will come. It'll come like a deluge. How we take that deluge in our society, and if we stop it completely like what we did 2000 years back, that no new things can happen, then we will become fossilized and we'll keep on getting defeated. We'll have to create as a society a framework to allow newer activities in a more controlled way. When it becomes large, becomes useful, understood by the society, then they come in a bigger way and stuff like that.
Mr. Mahalingam, I'll add one more thing I forgot. I think India is also unique in one more way. I think in India I have seen the government and regulators actually driving fintech and change related to technology. Look at examples, UPI or account aggregator or ONDC, or now what RBI is doing, that they have brought players together and started this pilot project where Kisan loans can be given in 7 minutes in some states where the land records have been digitized. You don't see regulators around the world doing something like this. But in India, they seem to be driving fintech regulation in a very regulated way. So they're saying, I've created a platform, It is for free. Come to that platform and use it. So in that sense, the fintech innovation is pushed even further because industry-wide platforms are getting created. And we don't have one. We have quite a few now. And people don't realize there is a trade finance platform. There are now 4 or 5 licenses on that where all MSMEs can come and get themselves discounted. So it's very unique to this country where the government and the regulators are actually creating these platforms. So in a way, they are also pushing fintech in a very unique way in the country. So I just wanted to mention that.
So just to add to this, basically I call it what I call soft infrastructure. There is hard infrastructure, which is what used to be the engine of growth for developed economies, that they create beautiful roads and great ports and great electricity, power generators and airports and everything. And that's what gave them what I call prosperity there. Today, India, in a way, in say 15, 20 years, and more importantly, last 10 years, leapfrogged from a 18th century technology to straight away 21st century technology in the soft infrastructure. The hard infrastructure, we are still poor. Soft infrastructure, we are so far ahead that literally US or China cannot catch up. And for me, going forward, this soft infrastructure is going to be basically the strength, and by quirk of it, as you said, we have uniquely created a government which is technology savvy. We have created regulators which are technology savvy. They are putting together CoWIN and Jan Dhan Aadhaar Mobile and GST. There is no such GST anywhere in the world, I can tell you that, which can track even a truck movement which is going khali, right? So effectively, there is no CPC in the world for income tax. And so we have basically become very, very techno-centric, techno-using society. And in a way, we are leading the world in not only UPI, not only commercial transactions, but governance of direct benefit transfer and so on and so forth. And that's what for me is a great hope for India. At the same time, if we don't control it well, you don't have to control, but at least have ability to allow them faster, better, but also ensure that in case something blows up, we have ability to control, create more risk-managed activities, more diversified activities. Probably we will be better off. But when you create diversification, again, you will have issues of rampant movements.
One small thing, Ashish, here. Fine. On technology aspects, I think all of us agree that India has really, taken real big strides. Let's look at the governance actually, particularly in the capital market, the strange institutions of MIIs. When you talk about the stock exchanges or the clearing corporations or the depositories, they are performing a kind of a dual role, which perhaps I think many of the institutions don't perform at all. They have a profit-making role, they have a regulatory role. Now, don't you think this is a kind of a hodgepodge mix, where actually we have seen instances where the governance has been given up at the cost of profits actually. So is this kind of a model, do you think, is it sustainable where you are putting a regulatory burden on them, but at the same time telling them that you need to make profits and you need to allocate money for investor protection and all that over a period of time? So is this model sustainable, or do you think there could be an alternative model here where perhaps you separate out these functions completely, don't keep it within the same institution? Now, this perhaps I think the capital markets regulator has also been examining in the past. They have been trying to bring in new entrants into the stock exchange arena itself. But unfortunately, we have not been able to succeed because the entry barriers are very, very high. So how do we resolve this? How do we go forward in this? How should the regulators look at this? Should they separate this? And like what Amitabh said, if we can open up just the trading platform to the fintechs, there could be more competition out there, given the regulatory role could be played by somebody else. How do you look at this in future as far as the capital markets are concerned?
No, I think again, the rest of the world has models. They have experimented. For example, US had the same dilemma in 1990s, which we had. And New York Stock Exchange used to be a regulator as well as a trading platform, as a service provider, which is commercial in nature. And that was true with NASDAQ and so on and so forth. And they thought that if they separate out, they would have solved those problems. So they separated out the regulations of the companies into SEC. They separated out the regulation of the brokers into another SRO called FINRA, which is actually owned, operated by brokers like our traditional exchanges. But effectively, it is, I mean, after that you have Madoffs, you have Phillip Capital, and in recent times, I'm just trying to count, but effectively, because we go through our own problems, we think the rest of the world doesn't have problems. They have even more severe problems. And today, there are 50 trading platforms. New York Stock Exchange, after 3 mergers, is now accounting for around 4% of US's volumes, although we have not been told that. And so effectively, there are larger platforms which have come up and so on and so forth. And there have been 400 Chinese companies which came to US markets, raised funds with the US government or whoever telling them that you don't have to even have reporting under financial accounting standards of US or any other standards. They did not report anything. They went away. Nobody bothered. Basically, it's the concept of whether you want a laissez-faire market like US or you want a protective market like India, where if investor makes money, it's his brilliance. If investor loses money, it's SEBI's problem, right? And for me, you'll have to figure out what regulatory framework you want. Once you get those situations, otherwise fintech, Zerodha is a fintech, right? They are doing very well and better than Robinhood. I mean, if you look at Robinhood, what's the Zerodha? Not that Zerodha may not do it later on Robinhood, so I don't vouch for that. But till now, because of the way we are regulating, so in some ways, we are just trying to see only one Robinhood and say this, but Robinhood has now slowly gone away. I mean, it's withering away, whether it has not come to our notice. When it was going up, it came to our notice and stuff like that. So for me, you'll have to figure out as a society, what do you want? This is a via media, whether you want to have 2 exchange, 2 depository, 2 clearing system model, or 15 of them, or separate out the regulations. It is basically up to the society. The other side, like US, as one example where the regulations are separated and the commercial part is separated, and now you have many competing products, but you don't know where the liquidity is. Because once a Nobel laureate came to Mumbai, I asked them that if one person has placed order of 100 shares into 50 markets, and one of them gets traded, what will happen to the liquidity which is looking like a 50x of that? And so there are other questions on financial theory part of it, but Japan had the other way around. Japan had 2 exchanges. One was in Osaka, other was in Tokyo, which all of us know. Osaka was not well known, but they merged it into one single exchange called Japan Stock Exchange Incorporated, and so on and so forth. So for me, there is no right answer. It is the people who manage and how the regulator actually regulates. Put together, we can get a right answer. But if we have people who are not sort of managing well, or overall system is not controlling them well, you will continue to have problems in 50 or in 2 or 1, right? So that's how I would put it.
Actually, staying on in governance, Amitabh, thankfully we didn't have too many S-Bank type episodes in the country. Banks are fairly well governed. But do you think actually going forward, can we take the governance for granted in banks? As regulators, we don't want S-Bank episode to be repeated ever at all, because that really sends tremors across the country. So how should the regulators look at it? I mean, should the regulators be a little more granular as far as the corporate governance is concerned? Or should they stick to principle-based regulation? Or do you think the regulators have no business as far as corporate governance is concerned? It is something which is inborn. It is a culture which has to be ingrained within the organization. How do you look at it? How will it evolve in future actually?
Oh, very clear. I think the regulations will only increase over a period of time. And it is happening already. I mean, as I said, invariably a lot of regulations and a lot of changes follow a certain crisis. I think after the Yes Bank, PMC Bank episodes, I think RBI and a lot of other regulators, I'm sure, sat around a table and decided that from a board governance and management governance perspective, they need to intervene, check, provide oversight, give direction, give guidance, much more than what they've done in the past. That is already happening, and I don't see this going away. Frankly, in Europe, already you are seeing supervisors sitting in board meetings and board committee meetings. It has gone one step further. The CEOs of some of the larger banks of Europe are actually complaining to the supervisors, saying that you are actually sitting with us and almost deciding a strategy. So it has already gone to that level. And I don't see any reason why that the regulators will not continue to push more oversight rather than less oversight. I think this idea behind principle-based and micro-regulation has been discussed in India for long periods of time. I think the evidence very clearly shows it has moved only in one direction, and I do not see any reason why it will shift to a principle-based regulation. It will be very interventionist, and I think we need it. I think history again also shows that the moment you pull back, you always find people, some rogue people or rogue teams or rogue promoters who will take advantage of it. And frankly, that's why the regulators, I think, I'm sure, have come to a conclusion that this principle base does not work. And fintechs, what has happened with fintechs, some of the things which have blown up, again, a good example of if you stay away, you are creating a problem for the future. So I'm quite clear it is headed only one way.
Thank you, Amitabh.
And sir, on the issue of the exchanges being commercial versus the regulators, my framework, which I now I'm trying to instill in NSE also, but I did for 13 years in BSE too. And my ex-boss, Dr. Patil, did it in first 8 years of NSE's existence, is that the regulation is the first job. That is the prime. I mean, you have to provide continual operations and regulations or compliance, and profit is an outcome of that activity. So when in doubt, regulations are supreme. If you get profits, it's fine. It's nothing to do with your activity as CEO. Your job is to run regulations. You might create profits, but that is not your you should not be measured on that. Neither your board should be measured on that. And you may not create profits, still you should not be measured, but any activity which is not generating profits in at least some amounts is going to become basically, in a way, slowly fossilized. So somewhere there is a minor part of that, but if you keep the MIIs, if you want to keep this model of regulator with commercial part, you'll have to, like what you did in your committee. I think it is absolutely imperative for everyone to read Mahalingam committee report, which is like very clear that the regulatory part or compliance part and providing uninterrupted orderly services is what the MIIs are for, and the measurement of the management of the board should be on that basis. That's what the lessons I have taken from his committee's report.
Okay, one provocative question, Ashish. This is on investor protection. I very strongly believe that the depositors in a bank need much more protection than the capital market investors. But look at what is happening in the country. The depositors are given a ceiling protection of 5 lakhs. The investors in the capital markets are given a protection of about 25 lakhs. The investors enter the capital market with the full awareness that it's a risky landscape. They are bound to incur losses. They can't really lean back on the shoulders of the regulators to get the investor protection at all points of time. Now, how do you look at this in the sense that whereas if you look at the capital markets regulatory approach today, everything is primarily on the investor protection. I believe that there is an overkill on investor protection. How do you react to this provocative question?
I think investor protection has several facets. And broadly, whether in mis-selling, even mis-buying, for example, even if you want to buy a nuclear bomb, you shouldn't be allowed, right? Similarly, there has to be some. So it's only when it comes to payment, that's where I think there is what a debate on whether it's too high or too low. And naturally, the brokers are not deposit-taking institutions. They are brokers. By nature, they are transactional. But when investors lose money, I have several examples where after default, the brokers have actually had a pact with many investors saying, I will get you 25 lakhs from NSE and 15 lakhs from BSE and you give me a cut also. So the guy who was basically had cheated the customer now becomes a partner and goes through all the processes because they know the process better than investors and stuff like that. So effectively, but overall the investor protection is an essential feature of any financial institution because these are, whether it's for banking or for the markets. At the same time, how much, how, when, where, That is where basically the debate can be, and it has to be reasonable. If it is unreasonable, like infinite compensation, then in one transaction, and there are instances on NSE where even very large institutions have taken that guarantee of the clearing house, which is actually explicit guarantee, to sort of ensure that they take unbelievable risks with a knowledge that one side can default and will come on the exchange. So you are basically buying the protection at so low cost because it's actually a collective situation, collective insurance of, and so there are many such instances, whether only on investor side, on broker side, and we need to be very wary of doing anything in excess on either side. And we also, that's why the investor awareness and investor protection, investor education, all three have to go hand in. And today, after I joined NSE, I have completed 3 months. Literally every day we are issuing new notices to the market saying, don't fall for assured return schemes. And we have started now naming people who we don't even know, but they are collecting money from public for investing in shares. And then when those investors actually don't find that person later on, where will they come? They will go to SEBI's offices in those places or NSE or both places. And who will compensate them? How they will be, because that's not even on the system. And so on and so forth. There are many ways people will try to misuse the public gardens, right? Public utilities get misused more than used. And that's where we need to be very careful of how do we give away those gardens to people who can actually ransack, and then garden becomes useful to nobody.
We have just about 12 minutes. You want to have any last word on the depositor protection corresponding to what he said about investor protection?
Well, as you rightly pointed out, that's the amount.
I want to leave about 10 minutes for questions to the audience also. Yeah.
60 seconds.
Yeah.
I think the regulator, at least on the banking side, is trying to ensure that we never reach a situation where that kind of insurance is required to be used. We have had one situation, but even in case of Yes Bank, I think collectively the banking system came together and the depositors did not have to suffer at all. Given the kind of oversight they have, given the kind of capital requirements they have, given the kind of how the regulator has gradually, slowly pushed the banking system to where they are, I would say the chances of something like that happening are low from a banking system perspective. On the NBFC side also, our Reserve Bank has stopped. It's not giving new licenses for people to take deposits. Some of them exist, but again, the oversight and regulations is only increasing over a period of time. So as far as depositors are concerned, while the amount of insurance might be low, I think the number of measures which have been taken around it, I do very strongly believe that give depositors a lot of comfort that the institutions which exist are not going to go down in a hurry. And even if things were to go wrong, the Reserve Bank or the regulator will take enough action to prevent it, stop it, or force a merger if necessary, which they did, to ensure that the depositors are not impacted. So I think that, and there are enough examples which exist where, in spite of the fact that the institution was in a bad shape, or let's say almost bankrupt, RBI did come up with a solution which protected the depositors. So I don't see that to be such a big risk. Obviously, we cannot tell about the future, but if regulator starts believing that the risks in the system have risen, I'm sure this amount over a period of time might go up, because as with the times, as the size of the banking system increases, they will push this amount up, which means incremental cost for the banking system, but all of us have to live with it. What choice do we have? It's a price of the license. As simple as
Thanks a lot, Amitabh. We have about roughly 10.5 minutes for questions. If people can put up their hands. We can start with Sandeep. Sandeep Parik. You want the mic.
Thank you so much. Quick question for Ashish, and something which maybe you can comment also given the recent report. Is the concept of alternate exchanges for very niche and specialized products, for example, the bond platforms that we've seen with which have come from a couple of fintechs, and of course SEBI is looking at a regulatory framework for that. But I've not seen kind of a regulatory philosophy. Ashish mentioned that there's no one regulatory philosophy which suits all markets, and everybody has to find their own space. But maybe a bit more from you, Ashish, in terms of where do you see all these niche alternate markets, and the example of online bond market, now SEBI is trying to fit them into the stockbroker kind of pigeonhole. which really doesn't suit an alternate market. So just a bit, some thoughts on your philosophy, your ideas.
No, I think in some ways, Amitabh answered it well, how the regulators look at it, that if you want to do that activity, you have to fit into that situation. So if you act as an exchange, just because you call yourselves bond platforms, you must be an exchange. You should go by those regulations rather than saying, no, because we are small. It's not only bond platforms. There are other platforms like SME platforms, which also are acting as exchanges. And when the money goes, what will happen? Will those investors blame the regulator? Come back? Once you can give that answer, it's just because they are small. What I'm trying to tell you is that if you are raising people's money, taking from one guy, giving it to other, will you be able to take back is the question. And if a large entity has the same rules applicable, it should be applicable to you. Right? That is how I would put it. That is how I understand the current regulations, that if you are acting like an exchange, take exchange license. If you pretend that I am acting like a broker, but I'm acting like an exchange, then might as well become a broker. And that's where, although it may not suit that person's narrative, it's like if you are making money, then you should be RBI, right? But if you call yourself your cryptocurrency, then there is a problem, right? And RBI by nature has to be one, like every government. And once you say, no, but I am cryptocurrency, but I am not a currency, then there is a problem, right? That's why I'm just trying to give you those examples.
Sandeep, but your question of niche exchanges, I completely agree with. I personally feel this system where you have more than one exchange competing with the other is inherently conflicting. Basically, in a market, liquidity begets liquidity. So that's why despite whatever has been done by the market forces, despite whatever has been done by the regulator, the business is converging towards NSE and the other exchanges are not getting the business at all. So aren't we at this point convinced that we need to create some niche exchanges, which means there are exchanges which can deal in certain specialized products. You at least make a product differentiation. If you make a universal exchange and make the universal exchange compete with another universal exchange, you are actually segmenting liquidity, which is not going to be really helpful either for the market development or investors over a period of time. They will develop an affection towards one exchange and they will congregate there. That's what is precisely happening today. So I think this concept of niche exchange is something which is really worth pondering over.
And broadly speaking, with applicable regulations, so that money finally comes back.
Yeah, you can ask a question. Yeah, please. The person. Mike. Yeah, just one moment. Can you move the mic, please? You can move. Yeah.
Good afternoon to the esteemed panel. I've had the opportunity to appear before Shri G. Mahalingam in the proceedings, and Ashish Chauhan always looked up to you, sir, as a trendsetter, and Mr. Amitabh always been an inspiration. Sir, what I would like to say is that moment India floated the IFSCA, that is the International Financial Center Services, the first thing the government did was create a unified regulator rather than a separate regulator for all the financial services to be operated from that center. So do you think that a clue could be taken from what the government has recently done with respect to IFSCA of creating a unified regulator in terms of the general regulation in India? Further, with respect to the depositors' protection, SEBI has a platform, Scores, for the purpose of protection of investors, where all the investor grievances are automated. So with respect to depositors' protection, maybe RBI can mull over a platform on the lines of Scores with respect to depositors' protection. With respect to cyber security and cloud and data protection, I really congratulate the regulators, because RBI has recently come out with the draft directions on cyber security and management, which is open for public consultation. And SEBI has also come out with a concept paper on cloud computing and data management, which is also open for public consultation. In India also, we have a separation of profitability vis-a-vis regulation, because finally SEBI regulates the markets and the markets go downwards. So I think that creates a very good case for having a unified regulator, as suggested way back in 2011 by the Financial Sector Commission, which talked about the draft code, the draft financial code, a unified code, instead of having various regulations, and a unified regulator along with the central bank. And so the last question is, what is the rationale for RBI to float a CBDC when digital payments are in vogue? Thank you so much, sir.
I consider most of them as more as observations actually, rather than trying to ask questions here. So, I mean, we would take these observations as far as whatever RBI has done and SEBI has done. Maybe on the CBDC, the question is more about the central bank trying to start a digital currency which is going to be useful to counter some of these forces which are actually, as Ashish mentioned, it is becoming a kind of a quasi-legal tender actually. So if you can actually digitize the whole thing and you can give these facilities of using a currency which the central bank itself is going to float, at least the attraction for these other quasi-legal tenders will evaporate. That's the idea. One time for the last question from this gentleman.
I've got a slightly provocative question. I'm Sandilya. Most of the regulations in our country have been knee-jerk reactions to frauds that have taken place. We have seen that time and again, a few which are ab initio. However, the frauds have taken place over a period of time. They are not overnight. They have taken place over 4 or 5 years, and things have been picking it up. And suddenly one fine morning wakes up and we do this. What is it the regulators can do to ensure that there are signals that are available? Lots of documents, lots of reports being submitted quarterly, half-yearly, and what have you. Why is it the signals are not being picked up in time so that we take action rather than taking place after 5-6 years and then suddenly waking up with a number of frauds have taken place all over a period of 5-6 years? That's the question. What do we need to do from a regulator's point of view to prevent our timely identification of frauds that are likely to take place? Thank you.
I think firstly, let's admit the fact that the first line of defense is not the regulator. The first line of the defense is the institution who's giving out this money and doing stuff of that nature. So, I mean, as when Ashish was pointing out, we all blame SEBI for everything. I think ultimately the institutions themselves did not do their job first. So let's accept that fact. Secondly, I think with all kinds of data which is available now, both to the mainline institutions which are actually doing all this, plus RBI, I think with the analytics which is taking place, the ability to spot some of those frauds is becoming better. And by the way, the regulator has done a lot of stuff to ensure that they can connect the borrowers in a certain way, the data flow can be checked, and so on and so forth. Third is that yes, the level of oversight has increased. New regulations have come in terms of ensuring that every institution in the financial services system is recognizing a borrower for what they are in the same way, rather than everyone doing their own little thing on the side. So they're trying to bring in consistency. They're trying to ensure that everyone is looking at the problem in a similar fashion. And obviously, a lot of other regulation has also come around resolution of the problems. I'm not saying that fraud will not happen, because fraudsters are always, sometimes ahead of what the regulations are. But the obvious frauds which India has gone through, some of the obvious things which people have done will definitely not happen. But frauds will take place. We are in the risk-taking business. For us to assume that some of these things will not happen is also stupid. It will happen. We will keep learning from it. And hopefully, over a period of time, the number and the amount of frauds will come down. But look at it, things globally, how things are blowing up overnight. I mean, the people, just the latest crypto which have blown up, you go and look at the comments about that individual and how he was revered almost like a god and how quickly it has blown up. $30 billion gone. So, in spite of, we assume that the regulators outside are better and we assume that the Western world knows how to do it, look at what has happened. So, I would say that with the kind of regulatory framework we have, with the way how regulators think about it, I think their pulse of what is happening, their interactions with the system are pretty solid. And yes, some things will happen, but generally, we have learned our lessons, and hopefully some of these things will not get repeated in the future.
So philosophically, basically, it's what I call how the humanity has evolved in terms of its own, each society has created its own regulations, like Hammurabi's code or whatever codes. It's basically on what I call rear view mirror basis. Something wrong happened or something unusual happened or something not acceptable happened, And that's how you create those codes and then you codify them into law and stuff like that, right? And that's how what I call rear view mirror based driving, that you always, as a society, always take past experiences and codify what had gone wrong, that should not go wrong. If you try to anticipate too much, then you will have basically no way to move because everything will look like a fraud, right? So effectively, that the balance you need to maintain, and because the life used to happen slowly, the past fraud could be avoided by having regulations to stop it. But the life is moving so fast now that past frauds are also becoming obsolete. The newer frauds are becoming even more interesting, so there is a bit of an anticipation required. But once you anticipate, then everyone will come back to the regulator saying, boss, what are you doing? How can you anticipate that I'm going to commit murder tomorrow? And that is where basically this debate will continue. There's a rear view mirror based driving or anticipation based driving, and that probably
Ashish,
will
now the
keep on
front
getting
view
us
mirror
here.
says time is up.
Absolutely. Thank you.
Thank you. Yeah. Thank you very much.
Thank you very much,
Thanks a
Mr.
lot.
Mahalingam. May I request you to please remain on stage as I request the former RBI Deputy Governor and the Chairperson HDFC Bank, Ms. Shyamala Gopinath, please do us the honors of presenting each of our speakers with a caricature that has been done, as well as a certificate stating that 10 trees each have been planted in their names. So you can begin from there.
Thank you very much, madam. Thanks a lot.